How should you be thinking about the role of debt when it comes to value investing? That's a question that I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And this is once again the Q&A series that you guys have absolutely been loving. And I got a very interesting question that I think is very important. You see it come up in every one of my models, which is debt and how I think about it as it relates to value investing. And so firstly, I'd just like to say that you guys are asking great questions. So keep hitting me up with your questions in the comments below, and I'll try and answer as many of them as I can in this Q&A series. And so let's get into this question. And I made a little presentation for you guys. So in value investing, I think debt can be an important consideration because it can impact the company's financial health and risk profile. And so when it comes to the areas of consideration that I have when it comes to debt, I look at two areas. The first one is, how does the debt impact the risk profile of the business? And then second is, how does the debt impact the intrinsic value of the business? Of course, the risk profile is the most important, because if you have an ultimately high, like riskier company or riskier operations as a result of the debt, it's just going to press down your intrinsic value. And so this is the most important part. And so I'm going to cover this in more detail, but there's a part of, how I build valuation models and how debt actually impacts the intrinsic value. This is something that, doesn't necessarily get taught in school. And so you guys might find my views on this pretty interesting. And so I'll cover that as well. And so how does the debt impact the risk profile of the business? Well, the first area that you need to look at is the capitalization. And so that, generally you can just call it the debt to equity ratio. And so it measures the amount of debt the company has relative to its equity. Obviously, if it has more debt than equity, or a higher debt to equity ratio, it can potentially indicate that the company is highly leveraged, which can increase its risk of default if it's unable to meet its debt obligations. Now, there are some businesses that inherently just have high leverage as part of the overall capitalization of the business. You can think of like banks and such, but generally, on average, businesses shouldn't be predominantly debt and not so much equity. And so whenever you do see those types of situations, pay attention to it, because it could indicate that there's trouble on the horizon. And then conversely, of course, a low debt to equity ratio may indicate that a company has a strong financial position and is less risky. And so the one thing that I would want to point out is, when you guys run your screeners, you guys might be running screeners on return on equity or return on invested capital. I think mostly return on equity is the one. Just pay attention to a company with a high return on equity but a low return on assets, and they might be doing that with a unusually high amount of leverage to achieve that high return on equity, and that could be an indication that they're running a potentially risky enterprise. And that this could become even riskier in a rising rate environment. And so this is where the term like zombie company comes from. A company has a lot of debt, and they're just kind of their operating income is just sort of paying for that interest expense. But if the interest rates reset to a much higher level, then of course the company will not be able to pay the interest expense with their current income, and then now you run into other situations, and I'll describe those in a couple of slides from now. And really what that zombie company example is talking about is sort of like an interest coverage ratio, is what essentially is the operating income divided by the interest expense. And so that is the next part of assessing the impact of debt when it comes to value investing. Can the company that you're looking to invest in actually sustain its level of debt, or like the interest payments and even like principal payments that are required to continue to service that debt as time goes on? Now, the interest coverage ratio will only cover the interest portion. It's really up to you to sort of consider the principal portions as well, but let's dive into that. So the interest coverage ratio measures the company's ability to pay its interest expenses on its debt. And so here's, your generic formula for it. It's just earnings before interest and taxes divided by the interest expense. So for example, if a company has $500,000 a year of EBIT and an interest expense of $200,000 a year, well, the interest coverage ratio is 2.5. So that's relatively good. It indicates that the company is generating a sufficient amount of earnings to pay its interest expenses 2.5 times over. And so effectively, a higher interest coverage ratio is generally considered to be better because it indicates that the company has a strong ability to meet its interest payments. On the other hand, if you have a low interest coverage ratio, it may indicate that the company could potentially be struggling to generate enough earnings to cover its expenses. And now here's where the challenge comes, because this could indicate a couple of things. It could indicate that the company is at risk of default, especially in a situation or an environment where we have rising interest rates, especially interest rates that are rising at a rate much faster than we had previously expected. But here's the other issue. A low interest coverage ratio can be an indicator of an equity raise. In other words, the dilution of current equity shareholders to pay down debt. So be careful here. This is where I see investors get burned so often. This is one of those things that I really look out for as it relates to valuations of companies. And I think all value investors need to be aware of this. Don't just value at your companies and say, EPS is this amount because it's been running at that amount historically. Consider what a rising interest rate environment could do to your company's earnings, and are you in a place where the company is likely to issue equity to handle the higher interest rates, and so or essentially pay down debt so that it can continue servicing the interest rates and the principal payments. And so just be careful here. But the interest coverage ratio is only one metric that can be used to evaluate a company's financial health and risk profile, because the other thing that I mentioned previously in this video is that interest is only one item that gets paid. The company is also liable for principal debt repayments as well. And so what you have to do is you have to go through the 10K or the 10Q or whatever. Generally it's in the 10K, and look for that debt maturity profile, because that will indicate the principal repayment risk that you also have to consider as it relates to debt. And so the debt maturity profile, a value investor may consider the debt maturity profile of a company's debt. And I actually, probably should have wrote that a little bit stronger. I think they absolutely have to consider the debt maturity profile of the company's debt. And so really what the debt maturity profile does is it shows you the timing and the amount of debt payments that are due in the future. And so a company with a large amount of short-term debt may be at more risk of a default if it's unable to refinance that debt when it comes due. If the company has very long-term debt maturities, consider discounting that debt before deducting it from the ultimate valuation of the company. And so what do I mean by deducting it from the ultimate valuation of the company? Well, this goes into the consideration that I spoke about earlier in this video, where how do I sort of allow debt to impact the ultimate valuation of the company? And so here it is. If intrinsic value is, not if, is the present value of all future cash flows of the business, then presumably all outflows need to be deducted from that figure, including principal debt repayments. And so that's a very important point. And I think a lot of people miss that point when it comes to valuing or calculating the intrinsic value of the company. So, money is going to go out to pay down the debt over the life of the business. And so that money needs to be calculated or valued going out of the business. And so debt should be discounted. In a perfect world, debt should be discounted using the discount rate based on its maturity profile. And, if you go into my valuation model for H&R Block, you actually see me doing that. However, think about debt that is expected to be refinanced and consider giving it a longer maturity to discount against. And so, if you see large chunks of debt and that it's going to be refinanced, you can forecast out that it's going to get refinanced and discounted even further. And so you can do stuff like that. Or companies will tell you that they're targeting certain amounts or levels of debt. For example, in one of my models, I'm valuing a company by the name of Hewlett Packard or HPQ, and they actually tell you that they're targeting a certain level of debt into perpetuity effectively. And so you can actually discount that debt considerably as well, because you believe that the company has the earnings to sort of sustainably refinance it over the long term. So it's really up to you how you want to think about that. Personally, in the spirit of conservatism, I tend to not discount the debt. I just subtract it from the present value of future cash flows at its current value. And so, that might be something that people may consider a little bit too conservative, especially for companies like an HPQ, where, they're not going to be paying down the debt anytime soon. And so when they do pay down that debt eventually, they're going to use future valued dollars way into the future. And so you should really discount that. That's somewhere where we can sort of agree to disagree. I like taking the conservative approach, but that is one element in my value valuation models that you might want to consider valuing completely differently, and thus you'll get a higher valuation. But it's just how I like to operate. And if you want to get access to my valuation models, you can get access to them at the lower tier of the Patreon. And of course, if you want to join us at that higher tier, you can join us for an epic live presentation at that higher tier. Now, I'm really happy that you guys are enjoying the Q&A series. And if you've missed any of the videos, and I think they're very useful, you can actually get access to the whole series right here.